The economic collapse that occurred in 1929 was largely the result of a convergence of causes, the most major of which was an increase in consumer borrowing, an overheated stock market, and a lack of regulation. These three factors contributed significantly to the collapse of the economy. The market collapse resulted in the failure of a large number of banks, huge levels of unemployment, and a significant drop in consumer spending. All of these factors contributed to the Great Depression. In addition to this, the crash was responsible for a large increase in the number of people who were without jobs. One of the most severe downturns in the economy ever recorded occurred in 1929, when the stock market collapsed. There are many factors, including the following, that led to the extraordinarily devastating impact that the collision had on everyone involved. The stock market in the 1920s had reached an unhealthy level of speculation and market manipulation, which contributed to an increase in stock values that was unsustainable. The market had become overheated. This resulted in the formation of a bubble, which finally burst, which ultimately resulted in the crash that occurred in 1929. The crisis of 1929 was caused by a number of different factors. A lack of governing guidelines. The stock market of the 1920s was completely unregulated, which allowed for tremendous speculation as well as market manipulation. Because there was no one overseeing the market, it became overheated, which finally resulted in its collapse. Unpredictability in the world's financial markets. Due to the fact that the financial system in the 1920s was not nearly as well developed as it is now, the Great Depression caused the failure of a significant number of financial institutions. The instability that existed in the financial system, which was another element that led to the economic collapse, made it more difficult for people to access the money that they had saved. This was another component that led to the economic collapse. Impact on a worldwide scale. The Great Depression was an economic catastrophe that was felt all over the world and afflicted countries in every region. It was characterized by a prolonged period of economic contraction. The interconnectedness of the global economy at the time contributed to the spread of the crisis, as countries that were initially unaffected were eventually dragged down by the economic downturn. This happened because countries that were initially unaffected were eventually dragged down by the economic downturn. This occurred as a result of the fact that nations that were originally immune to the effects of the economic crisis were later brought down by it. Duration of the state of emergency. The Great Depression lasted for longer than 10 years, and it took the economy a significant amount of time to completely recover from the effects of the crisis once it had passed. The severity of the economic downturn for a protracted length of time had a substantial impact on society, and was a contributing cause of widespread poverty, unemployment, and social unrest during this time. The Great Depression was one of the worst economic disasters in history, and the consequences of the crash of 1929 were felt for a number of years after the event had taken place. This result was brought about by the interaction of a number of different factors. As a comparison, it is possible that the potential causes of a future crash may be different, and the repercussions may also be different, given the changes that have occurred in the global economy and financial system since the 1930s. Additionally, it is possible that the potential causes of a future crash may also be different. For instance, the extent to which technological innovation, increasing globalization, and intervention from the government all play a part in the economy could potentially be key variables in the settlement of a potential future economic crisis. People pay close attention to and place a high value on the insights that Warren Buffett has provided regarding the economy and the stock market due to the fact that he is such a well-known and successful investor and billionaire. In general, Buffett is known for the long-term investment strategy that he espouses and the emphasis that he places on investing in businesses that have solid foundations and an advantage over their competitors. In addition to that, one of his primary focuses is making investments in businesses that have been in operation for quite some time. In addition to this, he has been very vocal about the significance of avoiding market timing and instead focusing on constructing a portfolio that is well diversified and can withstand the volatility of the market. This is something that he has been advocating for quite some time. In the past, Buffett has cautioned investors against the dangers of engaging in market speculation and underlined the relevance of avoiding excessive excitement. In addition, he has emphasized the importance of avoiding uncontrolled exuberance. In addition to this, he has been extremely vocal about the importance of regulation in the financial sector in order to prevent market manipulation and secure individual investors. The stock market crash that occurred in 1929 was an important turning point in history, and the effects of this event were felt for a significant amount of time after it had a place. In the 1930s, this ultimately played a role in the development of the Great Depression. The economic collapse that occurred in 1929 was markedly more severe than any conceivable economic collapse that may occur in the future because of a variety of factors that contributed to its severity. The COVID-19 pandemic has had a tremendous impact on the economy of the entire world, resulting in widespread job losses, cutbacks in consumer spending, and interruptions to supply chains located in many different parts of the world. The increased interconnectedness of the global economy has made it more vulnerable to jolts in the economy, such as those caused by natural disasters, trade disputes, and geopolitical concerns. Because of this, the global economy is made more susceptible to jolts to the economy. There has been a general tendency toward growing income disparity around the globe, which may result in decreased consumer spending and sluggish economic expansion. One possible cause of this trend is globalization. Two potential implications of political uncertainty in certain countries are increased market volatility and a more cautious approach to investment and spending. Both of these results are related to the economy. Natural disasters such as hurricanes, earthquakes, and droughts have the ability to restrict economic activity and result in large financial losses. This is the case since natural disasters are caused by natural forces. In some countries, particularly those with large levels of government debt, the capacity of the government to respond to economic crises and deliver support to enterprises and workers may be limited. This is especially the case in nations where the debt level is high. The escalation of trade disputes between nations can have a number of negative consequences, including the disruption of global supply chains and a slowdown in economic activity. What do you think of our video? Let us know in the comments section below. If you enjoyed this video and want to hear from us again, be sure to hit that subscribe button before you go. Thanks for watching.